Hey guys, Chris Clothier here with another episode of the Grind Podcast. And this week, I'm actually talking about something that we've had a lot of. Well, I mean, I feel like I said it a lot. We had a lot of interest in this. That's really where we come up with a lot of our topics. Is that it's through the conversations that we're having. But this one in particular is kind of funny. It's not necessarily about timing the market, but it's about understanding why we invest in the first place. The biggest power we have as investors, the number one thing on our side that actually makes our investments like supercharge and grow. And then I'm going to share kind of a little story today about kind of I guess it's an analogy of that. It's an example of that. It has nothing to do with necessarily real estate investing, but it's something, somewhere on my short list of things I love, the game of soccer in my family. And I'm going to kind of use an analogy to kind of bring it together to kind of tell you a little bit about kind of what happened and how I think it kind of relates to the topic today. So look, we get a lot of questions about timing the real estate market. And the questions really generally come in two forms. Number one is, I'm not in the real estate market and I don't know if I should be. Like, is now the right time or not? It's not frustrating. I want to make sure I'm real clear with this because some of our viewers may be like, hey, I'm the one who asked this question. It's not frustrating to me, but it's the fundamental not understanding timing of a market is what really, it frustrates me when investors are like, I want to sit in cash. I have the cash, but I'm going to earn a quarter of a point at the bank right now. Now, look, if you're in cash and you're investing somewhere where you're earning 10% on your money, let's say you've lent your money to REI Nation and you're in one of our funds and you've got cash in our funds and you're earning 9 points. I'm totally good with that. I mean, that's an incredible return that you're earning right now. But for those that say, I don't know what to do with it, I want to hold on to it, I'm nervous, I don't want to get started, I'm going to try and time the market. I think foreclosures are coming. We've talked about that in the past on our podcast. We don't really know what's going to happen with the real estate market. So this false idea that we can time the market, that's one part of our conversation today. You can't do it. There is an intrinsic feeling you can have. You can talk to a lot of investors and say, kind of, get the feeling from others of what's happening underneath. What's the undercurrent? Where's real estate going? Is it time to buy? Is it time to sell? And you can get a really good feeling for, hey, what do I want to do? Do I want to hold right now? Do I want to sell right now? Do I want to stay in cash, earning a quarter of a point? The answer on that is going to be no, always. You want to get your money working for you somehow, some way, but that doesn't necessarily mean you have to buy real estate right now. You may not be comfortable yourself, but understand there's no way to actually time the market. There's no way that somebody can tell you that today or this week or this month or even this quarter is the bottom of the real estate market. They can't even tell you that this is the year that it'll be the lowest point because next year it'll be higher and from there it's going to go up for a while. Nobody knows the answers to those questions. So to think that we can actually time, like I'm going to hold my cash over here and do nothing with it because I'm going to wait for the right time, that really is an indication that we don't have enough information to move forward. And so if you're an investor in that scenario, the way you time the market and the way you find the right time is when you have enough information to make your decision about moving forward. It's never a good idea to stay in cash. It's never a good idea to keep it in a savings account in a bank that is giving you a quarter of a point while they're lending it out to somebody else at 6 points. And they're lending it out 11 times over. So they're literally earning 66% on your money while they're paying you a quarter of a point. Don't do that. That's not intelligent. Emergency funds, you should have quick access to. I get it. Want to keep the money in the bank there for emergency funds? No problem. But when we're talking about investment funds, money that you should be putting to work, money that should be working for you, you got to get it out there. And to think that you might be able to ascertain the right time, that's a false idea. It's bad. Get away from it. Stop. because you rob yourself of the number one thing that means the most. Okay? And that is time. Let time work for you. So when you put your money into the real estate market and you own real estate and you're able to hold that real estate and you're able to afford to hold that real estate, time is working in your favor. Time is allowing your property to go up in value. Time allows you to be able to hold a property while rents increase, even if it's incrementally. Time is what allows a resident in your property to pay down your borrowing note. As long as they're paying a rent that covers your note, you're now actually someone else is paying it off for you. If you're in a market where rent almost, but not quite covers all of your monthly costs, and let's say that you're $50 to $100 under this month, okay? But you're in an appreciating market, and most times that's only where it's going to happen. It's going to happen in these markets or these submarkets that are going up in value. You're in a submarket where it's going up in value by $500 a month, but you're paying $100 to get there. You should realize you're earning 4 times your money of what you're spending. So I spend $100 to get $500. That is an amazing return that occurs over time. While if your property stays occupied and rents escalate, so every time you get a new rent or an increase in rent with a current resident, that number that you may or may not be losing every month shrinks down. The number you make in appreciation should continue to go up, especially if it's just a nice, even appreciation style market. You know, it's one of the things that we often miss and that we lose as investors is our understanding and appreciation for time. We talk to investors about a 5 to 7 year time period. You know, that for us is a good long-term investment. Somebody that comes in and says, I just want to invest for a year or two. I'm going to let the market go up. Then I'm going to dump out. There's nothing wrong with that. Not at all. But, and I'm not even saying that investors can't be successful that way. I mean, it's your investment. You need to do what you want to do. But we talk about a 5 to 7 year investment. 5 to 7 years, you know, it meets the gap that we are trying to create for investors. That gap is we're trying to fix a property up to a level where CapEx doesn't come into play for at least 5 to 7 years. And during that time period, if we are successful, and greater than half the time we are successful at keeping a resident in a property for that amount of time, then you experience little to no vacancy while you own it. So you have a resident that stays, you have CapEx that doesn't come into the equation. We are able to see that greater than half of the time, the maintenance cost annually remains below 4%, and it doesn't escalate above 4% until after that first 5 to 7 year period. In Texas, it kicks in a little bit after the 5th year. In Memphis, it kicks in a little bit after the 6th year. So that's before you ever reach 4% in maintenance costs. So we built out a model that says, hey, this 5 to 7 year period is the optimal period for your investment greater than half the time. So the averages speak to, if you buy 2 houses, 4 houses, 6 houses, 8 houses, half are going to perform better, half may perform below. But combined, they're all going to hit this metric, this number. If you allow time, so 5 years is 60 months, 7 years is 84 months. You allow 60 to 84 months for your property to increase in value, a resident to pay it down at the maximum level they'll be paying it down, allow us to increase rents while we go. So there's more pay down should you choose to put that extra money towards reducing principal. Some people choose to put it into their pocket, which is perfectly fine. It just lifts up the return you have on your investment. So during that 5 to 7 year period, that 60 to 84 months, that's when you are absolutely reaping the largest benefit of that investment because your costs are low and your opportunity is high for it to go up in value and a resident to pay it off at its maximum level that you can. So allowing time to do its job is massive, massive in real estate. Forget the idea of I can time the market and embrace the idea of using time when I'm in the market to increase the value of my investment. It's just a subtle little shift in the way we think about real estate. Get your money into an investment that leverages time to increase the return. That's where you want to be. And how do, I told you guys I had an analogy to kind of bring this on. We often talk to investors that if things don't go perfectly early on, or they're halfway through, the time period of their investment, and they're just like, this, it's just not doing what I want it to do. It's not sexy. I'm not going up in, big value. Maybe I've had a few maintenance costs here. Maybe I had a turnover, a move out after, year 4. 2 fully executed, 4 full years of fully executed management agreement. They stayed all the time they said they were going to stay, but they did move out, and I expected it to be there longer. We have that quite often where investors are like, man, it's just not quite hitting my full expectation. Well, there's a reason why we say that you want to hold it that 5 to 7 years. And look, I would be remiss if I didn't tell you right now that over 80% of our investors hold for longer than that time period. We've got investors that have been with us now for almost 2 full decades. I mean, we have a lot of houses that haven't seen a vacancy in over 10 years. That is a very real experience that investors have. But my point is this. So I'm at a soccer game, and it's an opportunity. It's the beginning of the state tournament, high school soccer. My son's out there on the varsity team, and they are in a game that they're losing. So you kind of, the way I kind of look at it is so far the experience hasn't matched their expectations. It was kind of a back and forth game, hot, muggy day, not a lot happening. It's just they couldn't get a lot going in the right direction. It was kind of, the game was muddled in the middle of the field, is a good way to put it. We get into the second half of the game, and these are, it's a 90-minute game. You get into the second half of the game, and the other team scores to put my son's team really on their back foot. Now they are losing. Now they're really not having the experience that they expected. I look at it as an investor. At this point, they're 90% into the game at this point. There's less than 6 minutes left to go in the game. And for a lot of investors, this is the point where they will have sold out. They will have said, this is just not meeting my expectations. I'm done. I'm gone. I'm ready to go home. They may have even cashed out before that. And they're not letting the full value of time kind of play all the way through. Luckily, in high school soccer, you play the full 90 minutes. And luckily for them, they stayed at it. In the last 5 minutes of the game, they scored the tying goal. To now, they've gotten hope. Now their expectation still isn't 100% of what they want. It's not exactly what they wanted. Now they're in a tied situation, but they're not losing. So, it's looking up. 30 seconds left to go in the game. And again, here I am, 30 seconds. So we're at the very last little bit, the last 1% of the game right there, and they score the winning goal. And they've either been tied or losing the whole way. Never really had a lot of expectation of being in the game. It wasn't even until the second half that they got dangerous and began to create opportunities for themselves. And, had they given up, had they decided at any point that this is just not going the way we want it to go, had they decided that I've given it enough time, but not all the time that I should give, but I've given it enough, so I'm out. They lose the game. But they didn't. They fought, they played, they stayed true to, hey, this is a 90-minute game. We're going to play for 90 minutes. I look at that the same way for investors. If you go into an investment and it's a long-term investment, it's not always going to play out the way you want it to play early on. You can't always time the market. You can't always say that now's the time to buy, now's the time to sell based on what the market itself is necessarily doing. You might end up finding that you cashed out, you got out of the game early before the real true benefit of being involved in the first place comes to fruition. And for these guys with this soccer game, they end up qualifying for the next round of the soccer tournament by scoring a goal with 30 seconds left. I mean, it was thrilling. It was unbelievable. And the I guess the thrill of that happening happens to investors all the time. That, this was an investment that I invested for the long term. It took it all the way into the 90th minute for it to fully pay off. But when it did, it paid off big. I cannot tell you the number of investors that we have out there that analogy fits perfectly, that it didn't go, the investment was not paying off exactly the way they expected or wanted throughout the investment. It was doing good, but not great. Sometimes it was not even doing good. It was like, man, this is not a great investment, but I'm going to allow time to work on my side. I'm going to allow time to play out for me. I'm going to allow these residents to continue to pay off my mortgage for me and pay this thing down, because every dollar that they're paying the mortgage down, it increases my equity. And one day this property will be worth a lot more than what I currently owe. And then you look up in the 90th minute and bam, there it is. A 7 to 10 year investment. Somebody decides to cash in, that it didn't look great in year 5, but in year 10, it was an amazing investment. Often due to the fact they let time do its job. So look, today's topic, obviously all about time, and the two different ways to look at it. One is, I think I'm going to wait for the right time. And one is, let time work for me. Instead of waiting on it, I'm just going to allow it to do its job. Get involved, get into the market, get your money working for you, and let good, smart decisions and time benefit you in the end. That's the best piece of advice I think I've got. And I appreciated getting the chance to use my great soccer analogy. I was a super proud dad that day. And my son will tell you that he's the backup goalie on the team, so he did not play that day. But just being a part of that team and being out there on that atmosphere in that crowd, I know a lot of investors that feel the same way. They feel like running and jumping into somebody's arms when they get their house sold and they get that check. And now they got to figure out what to do next. And many of them, believe it or not, this is not a plug, this is real, they 1031 exchange it right into something new. They go to the next round. So anyway, hey, look, everybody that joined me today, thank you so much. I appreciate you paying attention and listening, taking notes. If you have questions for us, as always, send me an email, leave us comments in our social media or anywhere that we are. Happy to respond, happy to engage. And until we get a chance to talk again, guys, commit to the grind. We'll see you soon. Thanks a lot.